Most people don't have a money problem. They have a fundamentals problem. And the difference between the two determines whether you build wealth or stay stuck living paycheck to paycheck. In today's video, we're breaking down the personal finance fundamentals that quietly create financial freedom. The exact principles that high-income earners, investors, and financially independent individuals follow. These are not trends, not hacks, not get-rich-quick tactics. These are evergreen wealth-building foundations that work in any economy, any decade, and any income bracket. Let's start with the first principle. Control the gap. The gap is the difference between what you earn and what you spend. That's it. If your lifestyle expands as fast as your income, you will always feel broke, even at 6 figures. This is called lifestyle inflation, and it silently destroys wealth. Financial freedom is built in the gap. The wider the gap, the more capital you control. And capital is what buys assets. This is why budgeting isn't restrictive. It's strategic. A budget is simply a spending plan that ensures your money flows toward assets, not liabilities. The second fundamental is building an emergency fund. This is non-negotiable. Before investing, before aggressive wealth building, before risk-taking, an emergency fund protects you from debt traps when life happens. Job loss, medical expenses, car repairs, unexpected bills. Without it, one disruption can wipe out years of progress. The general rule is 3 to 6 months of living expenses in a high-yield savings account. This isn't about growth. It's about stability. Stability gives you leverage. Leverage gives you confidence. Confidence lets you invest properly. Now let's talk about debt, because not all debt is equal. High-interest consumer debt is wealth poison. Credit cards charging 20% interest are mathematically working against you every single day. If you carry high-interest debt, eliminating it offers a guaranteed return equal to the interest rate. That's better than most investments. On the other hand, low-interest strategic debt, like certain mortgages or business financing, can be leveraged if it supports asset acquisition. The key is understanding the cost of capital. If your debt costs more than your investments earn, you're moving backward. Next comes one of the most powerful concepts in personal finance: paying yourself first. Most people spend first and save what's left. Wealthy individuals reverse that equation. The moment income hits your account, a percentage is automatically directed towards savings and investments. Automation removes emotion. Emotion is expensive. Whether that's contributing to retirement accounts, brokerage investments, or tax-advantaged accounts, the principle remains the same. Invest before you spend. This brings us to investing fundamentals. If you want long-term wealth, you must own assets. Assets produce income or appreciate over time. Broad market index funds, dividend-paying stocks, real estate, businesses, these are wealth-building vehicles. Trying to time the market, chase trends, or speculate on hype destroys portfolios. The real advantage is time in the market, not timing the market. Compound interest is not just a concept, it's a force multiplier. $1 invested today is significantly more powerful than $1 invested 10 years from now. And here's something most people overlook. Income growth matters just as much as saving. You can only cut expenses so far, but your earning potential is unlimited. Skill stacking, career advancement, side businesses, and digital income streams dramatically accelerate wealth building. Increasing income while maintaining spending discipline expands the gap, and that gap fuels investments. Now let's talk about protection, because wealth isn't just about building, it's about preserving. Insurance isn't exciting, but it prevents catastrophic setbacks. Health insurance, disability insurance, renters or homeowners insurance, these are shields. Without protection, one event can erase everything you built. Personal finance is about risk management as much as return generation. Taxes are another silent wealth factor. High-income earners don't just focus on making money, they focus on keeping it. Understanding tax-advantaged accounts, long-term capital gains, and retirement strategies increases net returns. Even small tax efficiencies compound significantly over decades. This is why financial literacy creates long-term advantage. Let's address something critical: mindset. Money magnifies habits. If you lack discipline at $1,000, you'll lack discipline at $100,000. Financial independence is behavioral before it's mathematical. Delayed gratification, consistency, and emotional control separate those who build wealth from those who earn high incomes but stay financially fragile. Wealth is less about intelligence and more about consistency. Another fundamental is asset allocation. Diversification reduces risk without sacrificing long-term growth. A balanced portfolio aligned with your risk tolerance protects you from emotional decisions during market volatility. Markets fluctuate. That's normal. Selling during downturns locks in losses. Investors who understand cycles remain steady. Let's simplify everything into a framework you can implement immediately. Control spending. Build an emergency fund. Eliminate high-interest debt. Automate investing. Grow income. Protect assets. Optimize taxes. Stay consistent. That's it. No complicated strategies. No secret loopholes. Just fundamentals repeated over time. Now here's the truth most people don't want to hear. Personal finance is boring. And boring is profitable. The people who quietly invest every month for 20 years outperform the people chasing the next big opportunity. Wealth is built in decades, not days. But here's the opportunity. Most people don't follow fundamentals. That means simply being disciplined already puts you ahead. Financial literacy is leverage. Once you understand money, it stops controlling you. If you're serious about financial freedom, start thinking in systems, not impulses. Create automatic transfers. Set clear allocation percentages. Track net worth quarterly. Review expenses annually. Make adjustments strategically, not emotionally. And remember this, your financial life is a reflection of your daily decisions. Small decisions compound just like investments. A 1% improvement repeated consistently creates exponential outcomes. The goal isn't just to make money. The goal is to build financial independence, where your assets generate enough income to cover your living expenses. That's when work becomes optional. That's when stress decreases. That's when you control your time. And time is the ultimate asset. If you master these personal finance fundamentals, you won't just survive economic shifts, you'll capitalize on them. Recessions, market cycles, inflation. Disciplined investors use volatility as opportunity. So, if you take one thing from this video, let it be this. Wealth is built on fundamentals, not excitement. Master the basics, Repeat them relentlessly. And let time do the heavy lifting. Financial freedom isn't a mystery. It's a formula. And now you have it.